Good day, everyone, and thanks very much for joining us. My name is Carl Nalter, and I'm part of the team at Easy. And as always, it's great to be engaging with our community. So thank you for the time to join us. And I'm particularly delighted to be joined today by Shaun Krom, who is our Chief Investment Officer at Easy Asset Management. And Shaun and his team are responsible for constructing and managing a whole bunch of really exciting products and portfolios at Easy. So welcome, Shaun, and thanks very much for joining us.
Hey, thanks for inviting me.
Shaun is often behind the scenes because part of his job is absorbing a lot of information. And Shaun and his team are also part of the group that launched, I think, just over a year ago, actually, a couple of actively managed ETFs. And the performance was exceptional. I don't always like giving Shaun too much credit, but the performance was really exceptional on the Easy ETFs, global equity, and the others. And yeah, Shaun, we look forward to chatting to you. And I'm going to dive straight into it because we don't have lots of time and people don't want to hear from me. They want to hear from you. So before we dive into specific markets, I want to chat, Shaun, a little bit with sharing with our community about how you think at Easy Asset Management. So many investors approach markets in terms of sectors or individual stocks, but you and your team often talk about themes. So maybe you can tell us a little bit, about thematic investing, why that matters, what exactly it is.
Sure. So, yeah, there are lots of different ways to invest, but our way that we approach it is we first want to find the themes that are driving the global economy. We think that those companies are directing the most amount of change and absorbing the most amount of profits. So the idea is that instead of investing in particular sectors, or people might talk about particular countries, should we be in emerging markets or more in the US or Europe or whatever it is, we take a much more thematic approach and say, okay, what are the tailwinds in the global economy? So like an obvious one is like AI. So we can see how, all the disruption that that's causing and the growth that that is. We go, okay, well, what else is there? We can see all the geopolitics, as let's say, going on in the world, the US versus China, where Europe sits in between that, what's going on with Trump. And instead of then saying, well, that's a risk to our portfolio, what we say, well, what's the opportunity of that? So we call that our multipolar world theme. And we say, okay, well, you have to invest in defense, tech, drones, space, as an example of that, onshoring, or reindustrialization of the US, or another one we've invested in is submarines. So the idea is like there's not only one theme, there are a whole bunch of different themes. And like even if we think of South Africa in particular, we go, what's an example of that multipolar theme in South Africa? Well, you can imagine that China and if other states will trust the dollar yet less. So they'll go, okay, well, we need to keep our reserves somewhere. Let's invest more in gold, or let's hoard resources. Maybe we want to keep a copper stockpile like we would keep an oil stockpile, or the same for critical minerals. So yeah, so we look around the world and try to figure out what are the themes that are driving that. I've given you some examples there, and obviously within they're like themes within themes. So like AI, you might just go top of mind, NVIDIA. You go, okay, well, that's a pretty obvious answer. But there are a whole bunch of things behind that share. It's like if you have a data center, who's building the data center? Who's pouring the concrete? Who's connecting the electricity? Who's actually providing the electricity? So even when you think of AI as a theme, there are themes within themes. And often our best returns have come from not just the broader theme, but like specifically how we've looked within that theme.
So super interesting. And yeah, and sure, maybe just to unpack that a little bit more and to make sure that I'm understanding it. So you're saying, a theme like AI, which everybody's talking about, obviously, and for good reason, and global restructuring doesn't mean you're going to invest in an obvious AI share like NVIDIA full stop. You mentioned an example. I want you to unpack it a little bit more because I found that interesting, submarines. So tell us how you get to that in the actual decision.
The way that we actually break it down is we have those broad-based themes. Once you have those broad-based themes, you then have a think about what does that actually mean. So, example, as a multipolar world, like Trump wants more industrialization in the US, or potentially there's going to be military conflict. So then you start to think, okay, in military conflict, where's the money going to be spent on? Is it going to be spent more on drones, or is it going to be spent on like hand weapons, as an example? And one of the things that's actually plays between the two is nuclear submarines. Like, not many have been built. We look for choke points. Like, there's only one company in the entire world that supplies the nuclear engine for the nuclear submarine. And that's like, if you want a nuclear submarine in when I say in the US, obviously, China has their own and stuff, but in the US, there's only one company. So it's like, you want it, like you have to go to them and you have to buy it. If you want batteries that go into drones that work in the ocean, so submersible drones, there's only one company that supplies those batteries. So it's not only just the big theme. So once you have your broad theme, you have to fit companies inside that theme. Once you fit companies, you have to go and do that sort of deep dive fundamental research to understand what's actually driving those companies. And then what we have on top of that is we have like a whole bunch of algorithms that just go and look through like the balance sheet and the income statement, current account, etc., and see what's going on there and start to rank those.
It's helpful context, particularly since you manage a lot of my retirement funds, that you're not just chasing a headline like AI. You're positioning ahead of, structural change that could lead to. So let's talk a little bit more about AI. Specifically, there's enormous excitement around it. At Easy Equities, we're passionate about AI and how it enables us to do so much more and better for our clients. There's been some volatility. And many investors are asking, is this a bubble, or are we still early, Shaun? And so I'm keen to have you chat a little bit about that. Is it a bubble, structural opportunity, AI, too late? What are your thoughts?
To start off with the headline, I don't even think we've begun. I think like we're at the beginning of the beginning. But I mean, the bubble question has obviously been raised multiple times. So I mean, maybe just start off addressing that. So why I don't think it's a bubble is generally when you have a bubble or many other bubbles, they're generally led by companies who aren't the strongest companies in the world. Like if you think that AI is a bubble, you have to believe not only, well, two things in this. Number one, you have to assume that the companies, the Microsofts, Meta, NVIDIAs, and so on in the world actually don't know what they're doing. They're spending too much. So you have to think like their management isn't the greatest management in the world, or smart to know what they're doing, which is kind of, if you have a look at their track record, that's quite a giant leap to think that you know more than what they know. So I think that's number one. Number two, the companies that are spending all this money are the most profitable companies in the world with a whole bunch of cash. It's like they spending cash that they already have. They aren't in the main borrowing. Generally, when you do have a crash, it is because of credit. It's over leverage. So there is starting to get some leverage in the system, and there certainly are some companies like CoreWeave who've really leveraged up their balance sheet. But even when they're leveraging up their balance sheet, number one is they got the contracts that come behind it. Mm-hmm. And then the final point I would say that why I don't think we're in a bubble is, so if you have a look at the internet bubble, it was like a whole bunch of dark fiber, which is just cables underground waiting to be, they call it dark fiber because it wasn't lit up. No one was using it. And the idea was sort of, if you build it, they will come. There's no like GPU out there that isn't getting used. If you can find a GPU, not only are you using it, but you can't actually overbuild. And why can't you overbuild? Because there are a whole bunch of extra constraints. So these constraints have actually moved from the chips and the chip manufacturing into the power sector. You can't just spin up a coal plant tomorrow or a gas plant tomorrow or a nuclear plant. All of this takes time. So, you're operating within a constrained environment, which even if it were a bubble, it's a very small bubble because it actually can't expand. It's like, imagine a bubble in a little box. It can't get big because in the little box, because there's only as much power as there is. So I think, we're just at the beginning. That doesn't mean that other companies won't be disrupted. Like we've seen, like the software stocks have taken a huge hit. But, where there's opportunity, there's also costs, obviously.
Shaun, so I loved your analogy about the bubble in the box. Can you maybe talk about AI specific to South Africa? Are AI opportunities limited to US and investors who invested in your portfolios who may want to look across wallets? Is the US the only place that we can mine these opportunities from an AI perspective or not?
Well, it's throughout the world. I mean, obviously China, but like has their own thing. In Europe, much, much, much more limited. There is some exposure that you can get in South Africa. So remember, when you're thinking about AI, you don't only have to think about the companies that are creating the AI or the infrastructure layer. You can think about the people that are using it, um, and the resources that have to go on behind it. For example, to wire up a data center takes like, I can't remember the number off the top of my head, but it's a huge amount of copper. So like you can imagine that the mine is all of a sudden, and everything's incremental in the commodity space. So in other words, you produce X amount of copper, and if someone wants 1 gram more, you just don't have it. So you can imagine that as you need more copper for data centers, as those are getting built out, that's good for the miners. Same as if you lay in those overhead cables, you're going to need copper, you're going to need aluminum. So you just think of resources as a general thing. Again, in South Africa, resources, I mentioned gold before. If people are distrusting of the US, or we're moving into a bipolar world, you can imagine you don't want to hold dollars, maybe you want to hold more gold. And then just inside that, I mean, just thinking of Easy as an example, you can imagine the companies that could be using the technology to improve their own processes, whether it's just customer service or to provide a better experience or take market share. And I think there are a handful of companies that are doing that quite well in South Africa too.
Do you think AI is going to make you and your team redundant?
It's a tough question. Listen, it's not right now. It could be. You might end up with a battle of the bots. It's like, so the analogy like I like to think about, or that I've thought about anyway. So like when computers came to chess and Kasparov was playing IBM, it's like first he killed the computer. Next thing, like the computer killed him. Then the next step was a chess guy working with the computer would kill a computer by themselves. And now a computer will kill anyone with or without a computer. The best sort of chess games are between two chess computers. So I don't know. The market environment is really messy. So I don't think we're there yet, but who knows?
Yeah, I think not, and I think it's going to kill people who are not using AI. I think using it is just going to improve what you're doing. So let's talk a little bit more about geopolitics that you've mentioned and that it's impossible to ignore. You've spoken about supply chain shifting, countries prioritizing security, and big changes in how global economy is structured. So specifically in a South African context, we had some data out in terms of unemployment, our recent State of the Nation address, inflation figures in South Africa. But, does all of this impact how you are positioning your portfolios, the South African context and the economics?
Oh, definitely. You can imagine, obviously, in your international markets, there are far more themes to be played than there are locally, but it definitely has a big impact in our local portfolios. Everything from like how we want to position ourselves into like thinking of sectors, although I don't like thinking of sectors, but like maybe you want more commodity exposure than you would otherwise. And then looking at specific companies is the idea to think about, is this company going to be an AI beneficiary, or are they going to be more of a dinosaur? Are they going to be able to move fast enough? And there are a handful of companies that have very innovative tech stacks. And some are not, and some just won't, I don't think will survive it, or will be much less profitable than they are right now. And the same thing you can think about again on the geopolitical side is like, are we going to be on the side of the West, or are we going to be more on the side of the East? And if you're going to be more on the side of the East, who's going to benefit and who's not? Like if you just open your borders completely to cheap Chinese cars, you can imagine what that's going to be to the labor pool of cars being produced in South Africa. What does that mean to, example, motors versus we buy cars?
So before we talk more, Shaun, just a general question to how you work. What do you read? What do you watch? What do you do? Where do you get your information from? And also maybe link that to our retail investors. So you and your team do a lot of the hard work so that we don't have to. This is the way that I view it, that I don't have to do that. I don't have the time or the brain to do what you're doing. So I will just invest in one of your portfolios. But I mean, where do you get your information? What do you guys do?
That's actually one of the things I feel really lucky about the job is I just love the actual reading and the analysis and everything that goes into it. So, I mean, we subscribe to a whole bunch of research services. Some of them are free, some of them are paid. We do like a lot of individual company analysis, going through, reading through their earnings, looking. There's so much information now. It's really actually great. You can go on YouTube and you can get hours of podcasts that different CEOs are doing or presentations that they make. There are a lot of stuff that we can get from there, and then cross-referencing them, seeing like what company one company is saying versus another company versus what one research service is saying versus another, and then we actually go in and read their company statements themselves and go through it. And like I said, we got some algorithms that we work on that helps us to put everything in perspective. Like we want to see like how's the gross margin doing versus the net margin? Are operating expenses going up or down? Does that match with what they say? And what's stock-based comp? What's the depreciation level and all the rest of it? Yeah, so it's really good like that. And like some of the things, I mean, this is actually one of the questions. How do we do what we do being out in South Africa where, you can imagine there are people going and meeting Jensen, who's the CEO of NVIDIA, once a week and have him on a phone call or whatever. So how do we do that? And the reason why is because there's so much information just on the internet. Like, for example, we get information on the chip side of things by subscribing to this one service. And they got guys who've actually worked at TSMC, who's actually worked at Intel and the rest. So we don't have to know how each layer of the chip works because we've got experts who've written that up for us. And then we go and say, okay, if we understand that, what does that actually mean? This actually comes back to your AI question. Is it going to replace me? A lot of the work is actually, now that I've read this, who is going to benefit? So like, I'll give you an example just this morning. So there's this memory. One of the problems that's going on in the AI space right now is you need a whole lot of high bandwidth memory. Memories normally has traditionally been a commodity, and there are a whole bunch of reasons that we haven't invested in that infrastructure, and it's really complicated how it gets packaged on top of each other, and it's hard to do. So there's this, your cell phones are going to get much more expensive, and like they're expecting your computers to be more expensive, and they're projecting like lower computer sales this year just because the memory is going to add like extra $200 to your computer. But what does that all mean? Anyway, so I saw this morning SK Hynix, which is a Korean company, they've just invested now. They've just confirmed that they're building a new lab. So this lab, like, it's really hard because it's in a clean room. To make a clean room, it's just really difficult. So anyway, they put in about 20 billion extra into it. And Micron goes, okay, well, if you're going to put 20 billion, we're going to put 20 billion. And that's all well and good. So what does that actually mean? So I go, okay, cool. If they're going to put 20 billion in, I want to buy the companies that are going to benefit from that spend of the 20 billion. Who are those companies that are going to benefit from the spend? So like an easy one is you might say like Applied Materials. They're a big wafer fab equipment manufacturer. And they've done really well. Their results came out recently, and like I think their share was up like 12% or something on the day. But they're a huge company. For them to get like an extra, they'll get like 40% of their money because they do everything. And that's all well and good. But like for them, it's actually a small amount. Maybe you want to go to a smaller player like Onto, or even like a company like Camtech, which is only like, I think it's like 8 billion. It's a much smaller company. So although they might only get 1 billion, if you only get 1 billion revenue and you get an extra billion, you can imagine what that's going to do for your share price. So it's the idea of reading this and then thinking, what does that actually mean?
I love that. And for those of you asking some of the specific companies that Shaun's mentioned and further information, if you go to blogs.easyequities.co.za, and if you do, you'll be doing so with hundreds of thousands of other people that access the material that Isha and her team put together. You'll see a lot of what Shaun's talking about and information from him, one of our colleagues, Shani. There's lots of really useful information at blogs.easyequities.co.za, all free. And you can also comment on social media if you want to see more, engage more. As you can see, Shaun gets super excited talking about this stuff because at heart he's a real nerd in the best possible way. This stuff excites him, and you're passionate about it, Shaun, which I love. So maybe talk to us a little bit how does this translate when you get it wrong? Like how actively do you watch your portfolio and short term? Like, is your mindset more medium or long term, or do you get worried if a theme has led you to a particular investment decision and it doesn't immediately drive performance? I mean, you must have pretty strong nerves to back your theme selection.
Yeah, so it's both like the picks within the theme and the theme itself. So if you remember way back when DeepSeek came out and we had like that, anything touching AI just fell like dramatically. You're talking like a 25-30% fall. So the way that I think about it is like, I think, is this theme still relevant? So there's two different things. There's the theme and the company. So like, is this theme still relevant? And a theme can be relevant, but not important right now or not useful right now. For example, at one time we had invested quite a lot into like green energies. And then I still think that that's a global theme, but I just don't think it's prevalent right now. So it just goes on the back burner and we follow it. And maybe it will pop up later and maybe it won't. And the same with AI. AI can have a tailwind behind it, but let's just say there's no more electricity, or for whatever reason, you just can't produce any chips. So we'll go, okay, we'll take that theme, we'll put it in the side, we'll watch it, and we'll invest in it later. Then there are differences with the companies that we invest within the theme. So how do we decide what to pick and then also what to kill? So what we look at, especially yours was more on the sell side. So we want to see, is that company performing according to what we expected? We have a whole bunch of like cash flow metrics, profitability metrics, and so on that we follow, and we want to make sure that they're going towards that and that they're actually achieving their objective. Like when you see their next earning release, or when you hear people talking, or what people are buying, you're seeing that they actually are buying those things. So that's how we see if the company is performing to how we expect it to perform. And then there's also things, just the opportunity cost. You can go and buy one company, let's say, so we had a big exposure in lasers as an example, and you have a look at that company and like we believe in it and it's doing really well, but there are other companies that are doing better in battery storage space. So we go, okay, well, it is quite different. It's still within that theme, but we're going to change one for the other because that's where we think the bottleneck is right now, or that's where we think we get better value right now.
Yeah, super, super interesting. Shaun, maybe you can talk a little bit around as we draw to a close here, criticism from some of the passive guys that it's better to be a bit more passive, to just track indices versus what you and the team are doing. I mean, do you have a view that it's one or the other? Do you think there's space for both in an investment space as retail investors?
No, so this is what I think. I think that passive definitely have their place, and there are definitely some people that should be more passive. And if I look at my mom, who don't like, it's really easy for her to put on the news and see what the top 40 did yesterday and S&P did yesterday, and she goes, okay, and like she understands it, and that's fine. But what we're trying to do is something completely different. Like our philosophy or our guiding principle is we don't want to have, like you hear managers, they want to be in the top quartile, or they want to beat the index by like 2%. We don't want that. We want to be the best manager, not the best manager in South Africa. We're aiming to be like the best manager in the world. And when we want to beat the index, we're not looking for like 20 basis points or something small. When we want to beat by 5-10%. We're looking for big chunky gains. And if you invest over the long term, the difference between earning an extra 5% a year and just being in the benchmark is massive. It's life-changing. It's one of the things like, you go, well, we're not curing cancer. Okay, so we're not, it's not the most important job. But you go, actually, this is a difference between you retiring comfortably and not. You being able to afford your medical procedure or not, or you being able to go onto the holiday you want to or not, or you sending your kids to a really good school or not. It makes a really big difference. So for me personally, I want the extra return, so I go in for. But that really depends on where you come in at. And if you're a more conservative investor, maybe you want to do it like 80-20, or maybe 100% passive, if that's where you're coming from. If you have a longer time frame, you can afford the risk. So maybe you want to take it 50-50 or 100 or whatever, that's for you to decide. But the difference is dramatic. You can run those numbers yourself and you can see that the difference is dramatic. And if you look in South Africa, most people retire without enough money. So what's the good of just being in a passive index if it's not going to get you where you need to go? And one of the things, this is an interesting, well, just an obvious thing I would say to think about is so one of the arguments for passive is also maybe we achieved it with lower volatility. Well, they'll go, well, we achieved this with lower drawdowns than you've had. And I'll go, okay, well, that's all good and well. But when you go out to go and buy your car, your holiday, they don't go, we'll give you a discount if you achieve this amount of money with lower vol. It's like either you have the 100,000 or you don't. It doesn't matter if you got it with a 10 vol or a 20 vol. It's either you have the money or you don't.
Yeah. I love again, sorry, I love again the passion, Shaun, and also how seriously you take it because, as you say, it's our retirement funds often. So it is important to take it seriously and not make haphazard decisions to really do the research and back yourself. We've got a question around fees, and so which is a good question because fees is definitely something that should be considered. And what I'd like to suggest is, if you're interested and what Shaun says makes sense, you can just log on, go to Invest Now on the platform, on the app, and select Manage Products, and you type in Easy, and all of these products that Shaun's been speaking about comes up. And if you go into each product, it's very clear what the cost profile is. And look at that, understand what you're paying for. It should not be hidden. It's certainly not hidden on Easy Equities. Fees are important. And I think, Shaun, often performance, the fees eat into that, particularly if you're only at a certain level of performance. So you wanting to shoot the lights out will also help and justifies the fees that you charge. But you want to talk a little bit about that?
Yeah, I actually think our fees are too cheap, to be honest. I had quite a few arguments when we launched these ETFs, what the fee should be. But besides the fact, I think the most important thing is your return after fees. So clearly, and that's hard. Like one of the things that the passives say is invest in passives because our fees are cheap, but you also know what you get in. Active managers say we'll beat the index, but our fees are high. And then often they don't outperform and they have higher fees. So you get that sort of double whammy. But I think the way to look at it is you have to look at that after fee return. And if you think the fee shouldn't be looked at as a separate thing to the return. It should be like, what is my total return that I'm getting? And you can imagine, I'll give a crazy example, but imagine you could be guaranteed that someone could get you a 50% return every single year, but you have to pay them 10%, which is 100 times more than you would get from like a unit trust. You'd definitely be happy to pay those fees. So who cares?
Yeah. Yeah, and good luck with your fee debate with our CEO. I think you're always going to lose that. He's always going to side with our clients and not your
Yeah, that's
um,
been lost and done.
yeah. Shaun, I want to give you a question from one of our users, Arnold, who agrees with you on the AI. We're just at the beginning, that it's really not a bubble, but he's asking, is there a risk of a dip due to the underlying technology failing to live up to the tech vision? For example, what if the tech is already nearly as mature as the underlying technology allows? So the tech would still be very useful and valuable products will still be developed. But if we're close to a fundamental limit, then much of the promise will be fundamentally limited. And Arnold's asking, what are your thoughts on that?
Yeah, that's a good question. I've thought through this quite
Arnold,
a
that's
lot.
high praise because Shaun has never said I'd give him a good question. So well done.
Yeah, because I've thought about this quite a lot. What happens if one of the things you just don't know because you're not in that space is like, is there going to be a next great model? It seems like there is going to be a next better and better, more model. And will we ever get to true, general intelligence? We don't know. But I would think if we had to hit a bottleneck now, if someone said you're not allowed to develop AI anymore, stop where you are. Think of all the products or think of your use of AI compared to what you see companies use. I think there's more than enough room for new companies to develop that we haven't. Think of like, you have a cell phone and now you have Uber. We haven't really seen too much of that yet. There is some of it, but not quite enough. Think of when you're using even Easy, how much AI is there in Easy compared to what there could be. Think of when you're banking, what there is, when you go and you're buying clothes or furniture or whatever. Think of in transportation. AI has barely made its way into the economy. It's really like dipped its toes in. So I think if everything had to stop right now, and you're not allowed any new models, I would think that there's still a lot of room for development, and that's where we would go. And one of the things that I have backing up in that is if you look at China. So China is behind in AI when it comes to like model development, specifically chips. They just don't have the same. They're much better in AI infrastructure, but they're like 3-4 years behind in the US when it comes to chips and the deployment of those chips in data centers. But they've done it in a completely different way. They said, how do we use the AI? So if you have a look in China, actually there's much more use of AI and much less development of AI. For some reason, the West has chosen the other way, but we are not even close to where China is, or the West isn't even close to where China is when it comes to the deployment of AI. So even if we had to stop right now, obviously some companies will get hit really hard, NVIDIA as an example, but other companies will do much better. I'll give you an example, like C.H. Robertson, which is a transportation company. Their profits, not this quarter, but the last quarter, this quarter, they still did well, but not as well as last quarter. So anyway, their profits were up 20%. And the reason why it's up 20% is if you're a transport company, it's really hard to speak to all your customers, make sure, like sometimes they don't even give out quotes because they literally can't deal with everyone. And then they have to do the pricing. And like that pricing is quite a manual thing that you do in Excel. And you say, what are you shipping? And how heavy is it? And how does it go here? And how does it go there? And so on. They used AI to do that. And they barely touched the surface of AI. And that's what they got, is a 20% uplift. And this is a transportation company. That's not even like tech forward. So, and that's only one of those companies. It hasn't even hit the bigger ones yet. So yeah, I think there's plenty of room.
Thank you very much, Shaun, for sharing your thoughts. And to you, Shawnee and the team, big thanks personally for looking after my retirement, but also on behalf of our users, because your smarts and your passion shines through, and we're really proud of Easy Asset Management and what you guys are achieving there. And a reminder, if anybody wants to check out any of these products, you can go to Invest Now, look at managed products, type in Easy, and Shaun's and the team's products will come up. Remember to check out blogs.easyequities.coza. Lots of useful information there. We've got some investment lessons from Bad Bunny, for those of you who are interested, right through to some serious company analysis and everything in between. So there's something for everybody there. So Shaun, wish you well with the team, and I think we must do an update at least once a quarter to the community. This will be available on YouTube as well, so share it with your friends and colleagues. And yeah, parting word from you, Shaun. No advice, but what is the one theme that we haven't spoken about that we should be watching, or the one share, or the one company?
I wouldn't say. I think you should create more diversity and have a look at so we obviously have a specialized ETF like the AI one, and we spent a lot of time talking about that. But if you have a look at our global equity ETF or the balanced one, there are multiple themes within that. So I'd be more comfortable. That's a portfolio that you could put all your money in, whereas AI is something you'd want to monitor more closely.
Yeah. Not advice, some thoughts from Shaun. Check it out. But thank you very much. And to the users, have a good rest of the day. And I like that. To the moon and back. Absolutely. Happy investing. And thanks for your time, Shaun.